evening, everyone, and welcome to Forex Street webinar of 7th of October 2014. My name is Nenad, and today we will talk about breakouts and how to trade them properly. The thing is that breakouts very often they occur, but people just do not know how to trade them properly. I will show you 3 ways how to pick up the entry and later how to get to the target point. So before I begin, standard is disclaimer stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with me. Online educational materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author, it's me, and in no way it represents the actual suggestion for a trade. These are not the MUK's opinions, and the website in the video is not a .co.uk website, but the globalnews.com website. Forex is risky business, and this is a personal opinion only. This webinar is informational and educational purposes only. With having said that, I will just give a brief presentation about myself, because we always have some new people coming in, and it's okay to present a little bit about myself. I've been a full-time trader since 2008, so this is what I do for a living. Spiders Den on Forex Factory is my proprietary thread, and my nickname on Spiders Den has been Tarantula with at instead of E, and that has been since I joined up. I also post on many other forums, especially worldwide investments, various investment blogs, and various including investing.com. Probably you have heard about investing.com, so that is a new thing for me also to post there. I am Admiral Markets head lecturer and an analyst, and as I'm saying, full-time trader. I'm the creator of proprietary price action trading method Camarilla MACD. I always provide prefect and real-time analysis, and I began writing for Forex Street in June 2014, and all my results and trading activities, of course, are transparent and they're used for full Forex education. So with having said that, we can proceed to our main subject. It's breakouts. So we are going to talk about what are breakouts, why and when to trade breakouts, then measuring the strength of breakouts, especially head and shoulders, triangles, flags, pennants, wedges, and daily highs and lows. So breakout is a term which we use when prices exceed previously determined support or resistance levels. Long positions are triggered when prices move above resistance, while short positions are signaled when prices drop below a clearly defined level of support. So in nature, you probably know what breakout is, but in nature it looks like this. If this is support, once the price breaks through the support, we call it a breakout. Once the price breaks through resistance, we call it a breakout. Now, there are many various types of support and resistance. We can have triangles, we can have head and shoulders, inverted head and shoulders, W, M, and so on. So those are breakouts. When important trend line, support, resistance, or daily high and low is broken, then we are talking about breakouts. Of course, breakouts on longer time frames create more significant changes, but breakout on shorter time frames have more impact on day trading. If you are a day trader, as I am, then you probably want to take breakout trading on intraday charts, especially 15 minutes, 1 hour, sometimes even 5 minutes, but I usually take those on 1 hour or 30 minutes or 15 minutes. 30 minutes is a good time frame to take a breakout trade, because on 30 minutes we can see some profit taking place, and usually new orders will set up after the top of the hour, TOTH. So why is it good to trade breakouts? First of all, huge momentum spikes can lead to very fast profits. Breakout trading is can be considered in a way also as a scalp trading, because breakout trades can be done as scalps. That is what I will show you, because there are three ways to trade breakouts. If we trade it as scalps, then obviously we are doing the fastest way of making profits. Now, the thing is, if you don't know how to do it, then you can also lose. So it can become a fastest way to lose the profit. Of course, it's always, we always need to take two sides of the coin. London breakout is a typical example. So the orders which have been accumulated in Asia session usually are triggered during the London Open. So if we trade the London Open, then we usually basically are trading accumulated orders in Asia session. We can trade breakouts also if there is no trend, but still there are levels, so we can trade. So if we don't have a trend, but we do have levels, there is also a good way to trade breakouts. Now, the important thing to know, to get a notice of, is that breakouts do so-called stop grabbing. Stop grabbing is a special, it's a normal way, but it's a special way to give your breakout trade a momentum. What is a stop grabbing? So let's say that you basically want to go long on a breakout. We call this trigger happy trade. More about that a little bit later. So you went long after an important resistance level has been broken. Now, you probably notice many times that the level which is broken is continuously, first it was rejected, then once it breaks, the price tends to go very fast in that direction. In this case, it's to the north side, to the upside. Okay? So, why does the price do that? It's because breakouts do stop grabbing. All short orders which have been placed above resistance have been triggered. So closing a short position is automatic buy. So when you close a short, it's an automatic buy. If you close a long position, that will be an automatic sell into the market. So that is very obvious. Once the important level has been broken, we will surely see a nice momentum. That kind of momentum, probably, if you know how to trade the price, will give us profits initially. Okay? So breakouts do stop grabbing, and stop grabbing helps us to make profits. You know how it goes in Forex market. Some will win, some will lose. Okay? So, when to trade breakouts? First, it's a London Open. We usually do that around 8 a.m. GMT. Right? London Open. Or London time. 8-hour London time. Early morning. Then trend trades, which we call scaling in. Then we can trade when there is no trend, and there is a range-bound market. But we also can trade it during New York Open, okay? New York Open. So now, bear with me. London Open, New York Open. There is a time when most of your orders and top of the hour TOTH trades will take place. So your breakouts would be much stronger, especially if they meet up with important support or resistance lines. If you have followed my analysis, I don't know how much of you have been following the analysis which I post every day on Forex Factory Admiral Markets blog, and I share it via Twitter. So the thing is, today we had a nice M123 bearish pattern breakout on Euro Yen, and that breakout was successful. Doesn't matter which way you traded the breakout, even if you get in with trigger happy trade, it was a successful one. So the thing is, if we manage to have a breakout during the London Open, during the New York Open, during the cross session when London and New York overlap, especially if they are in a confluence with support and resistance level, important support and resistance levels, we will have a much better success with trading breakouts. Also, we can take breakout trades when there is a nice breakout pattern forming. Double top bottom, triangles, wedge, pennants, flags, MWN, V. There are a lot of patterns which just appear, and a lot of patterns which naturally are observed by price action traders. I am a price action trader, so I use those patterns pretty much in my trading and analysis. So, now the question is, if Euro opens at 7 a.m., I don't do Frankfurt fake. So Frankfurt is not, I don't trade during Frankfurt Open. Back in time I did that, but some 3-4 years ago I stopped doing that because Frankfurt fake is traded not as a breakout trade. You can trade it by using fake out trades. Yeah, I'm talking about London Open, not Frankfurt Open. In one of our next webinars, I will show you how to trade fake outs. Now we are talking about breakouts, because breakouts and fake outs are different kind of beasts, okay? They're not the same. Breakout is different than fake out, completely different. So, opportunities and dangers of breakout include, it's a fast way of making profits. And by doing that, guys, you're basically trading the momentum, okay? So price has, fake out is a failed breakout. So price has a huge momentum spike because it collects stops above or below support or resistance levels. It's called stop grabbing. Contrary to breakout trading, failed breakout or fake out does not use a trend or market momentum. I will teach you one of our next webinars. I will show you a system how to trade a fake out. One good breakout trade is usually enough for the day. 10 to 25 pips is a good for a successful breakout trade. Now we are talking about standard breakouts, and if you're trading 20, 25 different pairs, it's pretty much enough for you. If there is a trend, we always buy into resistance or sell into support if we see a trend. Now, if there is no trend, if there is a ranging market, that can pose a real danger to us. Because then we sometimes do need to trade M1 and M5 breakouts with 5 to 10 pips of profits. You remember NFP trading. Don't trade higher time frames, because usually risk to reward will be poor, because I know that from my experience, trading higher time frames by breakout is usually very poor risk to reward, because you will usually get a nice momentum, let's say 10-15 pips, then the price, because you're trading of the higher time frame, the price can stop you out, because if you want to trade breakouts on higher time frames, that's just not suitable for intraday trading. Higher time frames are for investment. Higher time frame trading is usually for part-time traders, for traders who have a day job and cannot trade intraday. So breakouts are basically have been doing best on intraday charts and intraday time frames. So false breakouts are very common. So if we experience it, we need to immediately close the trade, then reverse it, but only if you know how to trade fake outs or false breakouts. It's simply not press the button and then reverse the trade. It doesn't go like that. Trigger happy trades make more profit, while retest trades are safer. So now we are going to talk about how to trade breakouts. So there are three main types of breakout trades. So we are taking breakouts in one of these kind of trading. Now, a quick question, then I will resume. Buy into resistance on trend. Which way, and sell into support when trend which way? Forex Boyki. Yeah, I will. If we are long, you need to take account that I will show you. Your questions will get answered through these examples. Yeah, buy into resistance, John, but only if three rules have been met. So you can go with trigger happy, with breakout pullback continuation, or a breakout retest. Now you need to know the momentum. Pay attention to what I will be talking about now. Okay? Okay. This is a trigger happy trade. Okay? Now, obviously, trigger happy trade is the fastest way to get into the trade the earliest possible way. Now, what does it mean? For example, this is called a flat bottom descending triangle. Okay? This is flat bottom descending triangle. When you see flat bottom descending triangle, you know that the price is basically in downtrend. Okay? So you want to take safer trades when this support, which is basically a trend line based support, breaks. Very often you will see that flat top and flat bottom triangles are the best ones. For trigger happy trades, as I'm saying, you need to go on intraday time frames. 15 minute, even 5 minute, 30 minute is the most suitable. Now, you don't wait for a closing candle. So this is the riskiest possible way to trade, guys. Now, I'm putting an exclamation mark. This is the way how you can trade breakouts. But this way is the most riskier way of all three kinds of breakout trading. You probably have noticed that many times when you have entered a trigger happy trade, let's say 2 pips below the support, you know that usually the price will get in your direction and you will get some 5, 7, 10 pips, even 15 pips of a profit. But then what can happen is you don't close your trade because of a reason. I don't know, maybe you want bigger profit, maybe you're too sure about your trade, maybe you want to be greedy, And then when it gets to, I don't know, 5 to 15 pips, it usually will reverse. And then you are in the problem because you don't know what to do, right? You know where you place your stop loss, usually after the last most obvious swing high if you're going short, vice versa for long. But the thing is, you will get in a panic mode. Now, that is the psychology of a trader. If you see 5 to 15 pips a profit, it doesn't sound much, right? We talk about 5 to 15 pips only. But remember, guys, usually those breakout trades are done with a slightly more leverage than we do it on intraday trading. So if you get into a trigger happy trade and you don't know when to close the order, you can get into panic mode if the price reverses and then subsequently gets back into the range of a previously broken chart pattern, let's say flat bottom descending triangle. Now, what I do usually, I don't do those trigger happy trades very often, but sometimes if I do it, I use trailing stop because I don't know when the price will reverse. You don't know when the price will reverse. You can only guess that. And believe me, guys, Forex is not a guessing game. It's not a game at all. It's a professional business, and you need to approach it as a professional business. If you want to play a guessing game, then Forex is not for you. Because you would be obviously guessing when the price will reverse, because anything can happen. You need to use trailing stop once you get into a trigger happy trade. If you see that price is making 5, 6, 7, 10 pips, use your break even plus something, but use the trailing stop or close the trade immediately after the price gets into some 5 to 10 pips in a profit, because you're doing trigger happy trade. You are not doing breakout retest or breakout retest continuation trade. That is how you should do it. Either close the trade, be happy with your profit, or use your trailing stop. And have in mind that a trigger happy trade is the fastest way, but the most riskiest way to trade the breakout. Second way to trade breakout is a called Breakout-Retest trade. You can boy key. I usually use 30-minute or 15-minute time frame, because usually those chart patterns will appear nicely on, especially triangles, on 30-minute time frame, but also on 15-minute. If you want to do it on 1 hour time frame, then place a triangle on 1 hour time frame and use 15 or 5-minute for entry. But you will notice those triangles very often on 15 and 30-minute time frame. I don't do trading on 5 and 1 minute. The exception was obviously NFP, but because NFP has a huge momentum spike, and we are talking about spike trading, then you can go with it. But usually, if you want to trade intraday, 30 minutes, 15 minutes, and 1 hour is suitable. Breakout retest trade. So let's say this is 15 minutes. It doesn't matter. You spotted a triangle, same one, flat bottom descending on 15-minute time frame. And you see that the price is basically making lower highs and lows. But lows are basically held within the trend line. This is called the vortex of the triangle, or a pinnacle. So this is a vortex or a pinnacle. Once the price breaks through the vortex or usually it will break very close to the vortex. The price will go again down, but then it will start to retrace. Support line needs to be horizontal if we talk about triangles. Now, Van der Meulen Onem is asking, has the support line, should support line be a horizontal one? If we talk about triangles, yes. It does not need to be a perfect one. It can have some slight, let's say a weak breaking through it or some, but it needs to be the shape of triangle. I have the examples later, so I will show. But the triangle is a good way to trade breakout, because once the price breaks close to the pinnacle or vortex of the triangle, it will go down. Then we don't know, remember trigger happy trade, we don't know when it will happen, but it will happen for sure. Once the price starts to retrace, you expect a lower trend line baseline test. It's called a retest. Okay, it's called a retest. So when we see a breakout and then retest, we can take the trade after the retest. So this is one swing, and now if the price starts to retrace, then we are talking about retest. Some traders trade immediately after the retest has been made. So once the price breaks and retests the same breakout point, some traders would place a short trade. That's called breakout-retest trade. Now, I usually zoom into 30-minute or 15-minute time frame, and if I see that the price is indeed touching the previous support, now resistance, and it cannot just make through it in first 2 or 3 ticks, I'm eager to go with a short trade. Because we know that important support has already been broken, and this is now an ordinary thing in Forex, which is called a retest. So if you take the trade here or within 5 pips close to a breakout level, it's called a breakout retest trade. And this is the optimal way to trade breakouts. The third way is called breakout pullback continuation. It's the term which I usually use in my analysis. It's called BPC, or a breakout pullback continuation. Some call it a breakout retest continuation. But the thing is, this kind of trading, or I should say this kind of trading, worked very good some 10 years ago. Today, if you do it on intraday time frames, it's not so valid, just because breakout pullback continuation does not give us a good risk to reward anymore on most of major pairs. You can do it on GBP and Euro minors, but on majors, except for GBP dollar, it's not so good as it was some time ago. What is a breakout pullback continuation trade? If the price breaks out, again, we use the same example. We have the triangle, flat bottom, descending triangle. So the price breaks out, retests, and then continues in the breakout direction. We call it breakout pullback continuation. So breakout point is point 1. Retest point is point 2. When point 1 is broken by 2 pips, we call it breakout pullback continuation. So breakout, pullback or retest, and continuation. Boyk is asking, is the best? To be honest, for me the best is the second one, a breakout retest. This one was the best. If you remember the time, I don't know how long have you been trading, But if you remember the time around 2005, 2006, GBP crosses, especially GBPN, went 300, 400, 500 pips of ATR in a single day. And usually that was the best time to trade breakout pullback continuation. Today I don't agree with that, because if let's say that you are taking the trade very close to next resistance and the price has broken, let's say, and it's 15 pips close to this resistance, okay? So if the price breaks this resistance, pulls back, and you go with breakout pullback continuation, you will have 15 pips to the next resistance. So from my point, this is the best way to trade breakout retest, because it will give you best risk to reward, and you will get a much earlier than you would do if you go with breakout pullback continuation. Okay? So breakout retest tends to be a safer trade, and generally it will give you better risk to reward than breakout pullback continuation in today's trading environment. Okay? Only it can be very good, but only if you trade, let's say, GBP Aussie or Euro Aussie or Aussie New Zealand, those kind of pairs which are much better to trade than Euro dollar, GBP dollar. I trade minors extensively. Then you can go with a possible breakout pullback continuation. Okay? Then you can go with breakout pullback continuation. Yes, for swing traders, you can go with breakout pullback continuation patterns. I am not a swing trader. You know John Savage, I know you from, we met on Admiral Markets webinars. I do intraday trading. I just don't do swing trading because, you know, if you're successful in one kind of job, then you don't switch it. So I have enough time to do intraday trading, so swing trading is not for me. That is why I rarely do breakout pullback continuation patterns. But if you want to do it with, as a sort of swing trading for the pairs which have great, huge average daily range, average through range, then you can go with breakout pullback continuation. But the thing is, this is how I usually do it. Today we had M pattern on Euro Yen, and in my analysis I show that if 136.90 is broken, the price target is 136.40. And what happened is the price got down. You could have gone with also with trigger happy trade, then it was a retest, and then the price proceeded down, more to the downside. Now obviously pullback continuation trade will happen once the trade gets, once this level gets broken. But mind me, it has only 20 pips till the target. So the thing is, as I can see, Euro Yen has almost touched final target. 136.55 is the low. So for all of those who are still in the trade, it's a good time now to think about either a break, even trade or something like that, or exiting out of the trade. What is the difference what others do by a breakout retest? The thing is about breakout retest trade. Some traders take the trades in the 5 pip buffer zone. So let's say this is 136.90 and the price breaks down, pulls back,
And once it's close to 136.90, you pull the trigger, okay? You aim and pull the trigger, as Forex Boyk is saying. You aim and pull the trigger. So if the price gets to 136.85, you can call it also retest trade, because sometimes market will move in your buffer zone, but it won't touch the price to the pip. Now, you can either wait for 90, obviously, if you do pending orders, or you can go with a 5 pip buffer close to retest zone and then basically enter the trade. So the only difference is some people use pending orders and some can enter market orders once the price gets close to the trend line retest possibility. Let's sum it up. Then I will show you the examples and how to place targets on chart pattern trading. Trigger happy trades are, Boyki is saying, please finish presentation before answering more questions. I'm trying to be pretty much simple as I can. I know we have 10 minutes, so I will be fast. And if there will be a time, I will answer questions, of course. But I don't like when questions are not answered. Trigger happy trades are very fast, but can be dangerous. With trigger happy trades, you can have a fake out mistake. Trigger happy trade should be treated as a scalp entry, and best opportunities to take trigger happy trades are breakout of Asia, London or New York range, daily highs and lows. So daily highs and lows are the best way to trade trigger happy trades, because usually when daily highs and lows after each session are broken, then we can have some nice pips, but only if you place, if your stop is not big and if you place a trailing stop. Daily highs and lows. Breakout retest trade tends to be more secure than trigger happy trade. Price doesn't always pull back to the entry. That is maybe the disadvantage, because sometimes you remember the price just breaks through resistance and proceeds down without having a retest opportunity. But for breakout retest trades, best opportunities are flat top triangles, flat bottom triangles, and rectangles. Breakout pullback continuation trades maybe has the worst risk to reward ratio, but the thing is, price will not always give you a pullback, price will not give you a continuation always, but same as for breakout retest trades. Flat top triangles, flat bottom triangles, rectangles, and swing time frames. Only swing time frames for breakout pullback continuations. And that is usually 4-hour daily. I don't talk about, and I've never trade weekly charts, but some traders do that. This is the simple, very simple head and shoulders variant. If you watch this pattern, this is left, this is head, this is right shoulder. This is neckline. Once the price broke through this neckline, it retested this resistance and proceeded to go down. The simple head and shoulders. Now, pay attention to this now. Very often you will see kinds of things such as this one. So, this is a breakout. You go with trigger happy trade here. This is a retest, so you can go with retest here. And this is obviously, from this point, breakout pullback continuation trade. So trigger happy trade, retest trade, below this, 2 pips below this, breakout, pullback or retest, a continuation. But sometimes you will see head and shoulders forms as this one. Again, very obvious. Left shoulder, head, right shoulder. Neckline. But look at this, guys. I always talk in my webinars that for me, wicks are more important than bodies. I don't know if other price action traders talk about that or do that, but for me, wicks are way more important than bodies of candles. If you watch this pattern, head and shoulders, you can see that this neckline has been broken, but the price has come very close to this retest zone. Now, the answer to the question which trader asked me some couple of minutes ago is the perfect retest rate would be at this point, but the market is not perfect. Very often, your retest points will be somewhere in the buffer zone. If you want to know how to calculate the buffer zone, then you just, if you have the wick, previous most obvious wick, such as in this example, you just place the line at the bottom of the wick, touching the wick. Simple horizontal trend line. And this will be also your possible retest level. Now, this is on 1 hour time frame. This is not much. This is something like 10 pips, maybe even less. But this is the zone which you can consider a safe retest zone. Okay, so the price is broken out, retested, and from this point it continued in breakout direction. So if you see that the price has made a wick, you just place a lower trend line at the wick, place a neckline, and go within 10 pips buffer within the zone. It's called trading in the zone. And this is how I do it most of the time. If I have pending order, great. But very often, not very often, but let's say 60% of the time, the trade will come very close to pending, not hitting the pending, but proceeding down. That is the time when I monitor the price. And when I see that it's close to my pending order, I can even enter here and there, keeping risk the same. So if you go with a head and shoulders pattern, yes, you go with a swing low before the left shoulder. So this was, but count, you need to use your common sense. This was most obvious swing point at the neckline, not this one, this one. You want to take a neckline into account, but also a swing point, because neckline would usually be a little bit leaned to the side. Boyki, I don't have the time now to explain why wicks are more important, but in one of our next webinars, I will tell you and I will show you why wicks are definitely more important than bodies of the candle. For some traders, maybe they're not more important, but for me, no, John, it doesn't have to, yes, momentum, but not just momentum. It's history of buyers and sellers. And we will talk about that in one of our next webinars. So, how to measure targets, how to measure the strength of breakouts. Pay attention to this now. We see, for example, flags and pennants. Okay, flags and pennants. This is called a flag. This is called flag. This is a pole. Okay, this is a pole. So the length of a flag pole can be applied to the resistance break or support break of the flag pennant to the estimate advance or decline. So if this pole has 150 pips in it, once the chart pattern has been broken, you add 150 pips at the breakout point. And you see this is 150 pips measured. The price has broken to resistance and went to the target. This is 100 pips, and look at this. 100 pips is here, and it almost made your target. So this is the ultimate gauge to measure the target. Yeah, but this is obviously a fake out. Obviously a fake out. Look at the wicks, and wicks are telling you this is buying, this is not selling. Okay? And this is obviously uptrend, because you are trading flags and pennants like this only to the upside. This is a bullish pattern. This is not bearish pattern. Because this is bullish pattern, you only consider the trading when top is broken, not the bottom. No, you don't go long when it comes back in the flag. You treat it like this: trigger happy, breakout, retest, breakout, pullback, continuation. Now I'm showing you how to trade breakouts and how to place targets on your breakouts. So you either take trigger happy trade, breakout, retest, and breakout, retest, continuation. So those are three ways to trade breakouts. And these are the examples of chart patterns breakouts. This is the same example as I showed you of head and shoulders, but this is the target. When a break of neckline happens, you just measure the distance from the neckline to the top of the head, and then you add to breakout point. So this is 55 pips. This was breakout point, obviously here, and you add 55 pips, counting the target as 55 pips. If you have important pivot point indicator or pivot point level, then you can add the confluence. I always trade with Camarilla, so Camarilla, if for example L3 level is there and those 55 pips are very close to L5, I am safer to assume that the trade will be magnetically moved towards the confluence supports. Triangles are also, as I said, great ways to trade breakouts. The widest distance of the symmetrical triangle is measured and applied to the breakout point. So this is the triangle, this is the breakout. So trigger happy, retest, continuation. But you measure 30 pips because 30 pips is contained within the widest portion of the triangle. Okay? And okay, 3 more minutes and we will wrap it up. So breakout, this is trigger happy trade, this is retest trade, this is continuation trade. Again, 25 pips, 25 pips, 25 pips to the downside. Breakout, retest, continuation. This is flat bottom descending. This is bearish pattern. Bearish pattern. So 25 pips, 25 pips. You can see that the targets are usually met. Wedges. For downward breakouts, the lowest value in the pattern is the price target. So this is the value because we are trading the short. Okay? You don't use MACD now, Vandermeulen, Onem. You don't use MACD for breakout trading. Look, breakout, pullback, continuation. This is trigger happy, this is retest, this is continuation. And the price has perfectly met the target. So for downward breakouts, the lowest value in the pattern is the price target. And finally, the last part of the webinar is daily highs and lows. So if this was the daily low and we had a new session coming in, we can take the trade once the daily low from previous session has been broken to next support. And I use ATR indicator which will print out the levels for an average true range number. Okay? So pay attention to this. ATR levels. This is daily low, let's say for New York session. Once the New York session low is broken and there is enough momentum to trade breakout, we can go with the trigger happy trade or
breakout retest rate or breakout pullback continuation to the par of the lowest ATR projected number. Guys, this is everything which I was and which I've been intended to show you, but unfortunately now we need to wrap it up. Next time I will talk about different subjects, but of course this should be recorded and you can take a reference whenever you want. Thank you guys, thank you everyone for attending the webinar. We will talk again soon. Cheers, and I wish you many green pips in upcoming week.